Let's look at a problem related to flexible budgets. So if you'll turn into your lecture notes, we'll get started. Copper Mountain Outfitters projected sales of 75,000 units for the most recent year at a unit sales price of $12. Actual sales for the year were 72,000 units at $14 per unit. Actual variable costs, budgeted at $4 per unit, totaled $4.75 per unit. Budgeted fixed cost totaled $375,000, while actual fixed cost amounted to $400,000. All right, so we are given here what we thought would happen and then what did happen. We're going to take a look at our static and flexible budgets, but before we do, we just want to take a look at what happened here as far as sales are concerned. Did the manager meet sales objectives for the year for price and volume? And what we find is that when we look at our performance report, this is sort of ignored. It just looks at if sales met the planned amount and if costs were kept within a certain amount. But as far as price goes, you would simply compare the actual price to the budgeted sales price. And we know that we actually sold the inventory for $14 per unit, and the budget was $12 per unit. So if we were to evaluate the manager based on price, this would be favorable. The other part of sales deals with volume, and of course, to evaluate if the manager met the right volume, we would compare actual sales volume to the budgeted sales volume. And if you look back at the information, you would find that we actually sold 72,000 units and we had planned to sell 75,000 units. So since we did not meet the budgeted volume, this would be unfavorable. These are variances that could be calculated, and in fact there is a way to do that. It's not really the focus of what we're doing here, but recognize that the manager would be evaluated first on did you meet the right price and did you meet the right sales volume. Then from there we would prepare a performance report and do the evaluation of the manager. All right, the second question says calculate the operating income for the static budget. The static budget is based on budgeted volume. It is the planning budget and is prepared before the period starts. So the static budget will be based on planned volume of 75,000 units. Remember, Copper Mountain thought they would sell 75,000 units at $12. They did sell 72,000 units at $14. Variable costs were budgeted to be $4. They came in at $4.75. And budgeted fixed costs were $375,000 and actual fixed costs were $400,000. Well, this budget is based on the planned numbers, so sales would be 75,000 times 12 or $900,000. Variable costs would be 75,000 units times $4 per unit or $300,000. The contribution margin then would compute to be $600,000. We had planned for fixed costs to be $375,000, so planned income was $225,000. Now what we'll find when we prepare the actual income statement is that we did not have income of $225,000. Prepare a performance report based on the flexible budget. What is the total cost variance that would be shown on the company's performance report for the year? So we're asked to first prepare the performance report and then determine what the total cost variance would be. When you prepare a performance report, you compare the actual results to the flexible budget. We don't use the static budget here. So again, I remind you of what was given, and The flexible budget and the actual results will both be based on the actual volume of 72,000 units. And that's what makes these two columns comparable, is that they are based on the same sales volume. Okay, revenue for the flexible budget. We had planned to sell our units for $12. We actually sold 72,000 units. That's $864,000 in sales. The actual results came in that the 72,000 units were sold for $14. That's $1,008,000. Next, we subtract the variable expenses. For the budget, we had planned for variable cost per unit to be $4. So 4 times 72,000 is 288,000. Variable expenses actually averaged to be $4.75, so the actual results will show $342,000. The flexible budget contribution margin is $576,000. The actual results, it's $666,000. Next, we subtract fixed expenses, and we thought that fixed costs would be $375,000, but they actually came in to be $400,000. So operating income on the flexible budget says that at a volume of 72,000 units, income should have been $201,000. It actually came in at $266,000. So we'll have a variance column that explains why income was $65,000 higher than we had planned for it to be based on the flexible budget. Clearly, a significant factor is that revenue had a $144,000 favorable variance because actual sales were much higher than the flexible budget. And we can see by the calculation that that's due to price, a $2 difference. Variable costs should have been $288,000 at 72,000 units. They actually came in at $342,000, and so that is an unfavorable variance of $54,000. Right, this leaves the contribution margin variance to be $90,000 favorable. You can see that fixed costs were higher than they were supposed to be by $25,000, so that variance is unfavorable. And this will net out to be an income variance of $65,000 favorable. So we were asked to prepare the performance report, and that's what this is. But specifically, we were asked what the total expense variance would be. And so total expenses are variable plus fixed expenses. So if we want to summarize that, the total cost variance would be made up of the variable cost variance, which was $54,000 unfavorable, and the fixed cost variance, which was $25,000 unfavorable. Since they were both unfavorable, we'll add them together, and it will net out to be an unfavorable variance of $79,000. All right, so that demonstrates how to calculate specific variances within that performance report. All right, that's the end of this problem. Get some practice and bring your questions to class. See you then.